You've watched my last two videos on liquidity. You understand the concepts, you can spot the zones on a chart, but something still doesn't feel right, does it? You're still getting caught on the wrong side of the move, still feeling that pressure to jump in just before the market reverses. That's because you've been looking at liquidity purely from a technical point of view. Today we're going to change that. We're looking at liquidity through the lens of psychology, pressure, and the hidden forces that drive your decisions. So, what is liquidity really? It's not just a pool of money sitting on the sidelines. It is pressure. It is a time constraint. Most importantly, it is a scarcity of opportunity. And here's the secret. The big institutional players, the big money, are masters at manufacturing that scarcity to force your hand. They create the illusion that if you don't act now, you'll miss out forever. This manipulation leads to a fundamental and costly difference in how professionals and retail traders operate. Big money trades when liquidity is high and volatility is controlled. They have the patience and the capital to wait for the perfect moment. But you, the retail trader, are often forced to trade when volatility is high and liquidity is low. This is the truth nobody talks about. You're not just trading against the chart, you're trading against a manufactured psychological trap. Let's break down this scarcity trap. It starts with a slow, grinding market. Price inches up or down, just enough to get you interested, but not enough to give you a clear entry. You're watching, waiting, and the tension builds. This is intentional. They are building the pressure. Then suddenly, a sharp, aggressive move happens. Panic sets in. The fear of missing out, or FOMO, kicks into overdrive. You see the price running away without you, and your brain screams, "This is it! I have to get in now!" So, you jump in. You buy at the top of a frantic green candle or sell at the bottom of a terrifying red one. For a brief moment you feel relief. You're in the move. But what happens next? The market stalls. It reverses. The same speed and aggression that pulled you in is now working against you. Your position immediately goes into the red. Why? Because you didn't enter the market. You were the entry. Your order provided the liquidity that big money needed to take the other side of the trade, to either take their profits or initiate their real position in the opposite direction. They used your psychologically driven decision as their exit or entry point. Think about it like this. Imagine a store that has only one item left on the shelf. A crowd gathers. Everyone wants it. The store owner can now name their price, right? That's what big money does. They create the illusion of a single, fleeting opportunity. They engineer a market environment where you feel like you're in a crowd, all fighting for that last spot. They trigger your most basic human instincts, fear and greed, to make you act irrationally. They don't need to know you personally. They just need to know how a scared, hopeful person with a trading account will react under pressure. And they know it with near-perfect accuracy. Let's start with a fundamental truth in trading, one that's been repeated for generations. Money flows from the impatient to the patient. It's a simple concept, but understanding its mechanics is the key to everything. Think about it. Who has more patience? You, sitting at your desk, clicking your mouse, feeling the pressure to make something happen? Or the massive institutions, the big money, with virtually unlimited capital and teams of analysts who get paid to wait for the perfect moment? They are the epitome of patience. They don't need to force a trade today or even this week. Their goal is to accumulate positions at the best possible price, and they know the most effective way to do that is by exploiting the impatience of retail traders like us. This brings us to the core of the illusion, the manufactured scarcity. Big money creates these long, tedious, and incredibly frustrating periods of consolidation. You know the ones I'm talking about. The price just chops sideways day after day. It's not exciting. It's boring. It feels like nothing is happening, and that's by design. This consolidation is a weapon. Its purpose is to wear you down mentally. They are creating a desert, making any sign of a breakout look like an oasis. The psychological pressure builds. You start thinking, is this ever going to move, or I'm wasting my time watching this chart? Boredom and frustration are powerful emotions in trading. They lead to doubt. You start questioning your analysis, your strategy, even your ability to trade. Your willpower erodes. Finally, you capitulate. You close your position for a tiny profit, or at break-even, just to feel some sense of relief. You tell yourself, I'll just wait for a clearer opportunity. And then it happens. Often within minutes of you giving up, the market explodes, a violent, aggressive push in the direction you originally predicted. The price doesn't just move, it launches, running through all the stop-loss orders from traders who were just as impatient as you. It's a brutal, efficient maneuver designed to capture liquidity and leave the impatient crowd behind. In the span of 5 minutes, the entire move you waited a week for is over. Big money has collected their shares at a discount from all the traders who gave up, and now they're riding the trend without you. What happens next? The aftermath is just as damaging. You see the move you missed, and a toxic cocktail of emotions floods your brain. First comes the regret, then the anger. You think, I knew it, I was right all along. This leads to one of two destructive behaviors: revenge trading or FOMO, the fear of missing out. With revenge trading, you jump back into the market impulsively, trying to get back what you believe was stolen from you. Your entry is illogical, probably at a terrible price, with no solid plan. With FOMO, you chase the price, buying at the top of the move, terrified of missing out on any more profit. In both scenarios, you are trading emotionally, not strategically. You've abandoned your rules. And what usually happens? The market, having reached its short-term objective, pulls back, and you're left holding the bag, nursing yet another unnecessary loss. You fell for the trap, and then you walked right back into a second one. This cycle is how accounts are slowly bled dry. But the manipulation doesn't stop there. There's a more silent technical attack that happens right under our noses, often around major news events. It's called the liquidity drain. You're watching the clock, waiting for the non-farm payroll report or an interest rate decision. You have your trade planned. The moment the news hits, you click buy or sell. But something strange happens. The price you get filled at is nowhere near the price you saw on your screen. You've just been hit by a widening spread. Here's how it works. In the seconds leading up to a high-impact news release, market makers, the entities that provide liquidity to the market, deliberately pull their orders. They step back. Why? To protect themselves from volatility. But the consequence for you is a sudden and dramatic widening of the bid-ask spread. That tiny gap between the buying and selling price can suddenly become a chasm. So when you place your market order, you're not just trading the price movement, you're trading into a widening spread trap. This almost guarantees slippage. Your order gets filled at a much worse price, meaning you're in an immediate loss before the price even has a chance to move against you. You might have the direction right, but the cost of entry, inflated by the spread, can be enough to stop you out instantly. It's a subtle but devastating tactic that preys on those trying to trade the news. So how do we combat this? How do we break free from the scarcity illusion and the traps laid by big money? The answer lies in shifting your entire perspective. You must start thinking like the patient money, not the impatient crowd. First, embrace the boredom. When the market is consolidating, recognize it for what it is, an accumulation phase. It's not a waste of time. It's the market preparing for its next major move. Use this time to refine your plan, set your alerts, and walk away from the screen. Don't let the chart hypnotize you into making a foolish mistake. Your job isn't to be an action hero, it's to be a sniper, waiting calmly for the perfect shot. Second, have unshakable faith in your own analysis. If you've done your homework and your strategy points to a specific outcome, trust it. Write down your plan, your entry, your stop loss, and your take profit targets. Once the trade is on, your job is done. Let the market do the work. Resisting the urge to constantly tinker with your trade is a skill, and it's one of the most profitable skills you can develop. Remember, patience isn't just about waiting to enter a trade. It's also about having the patience to let the trade play out according to your plan. Third, be acutely aware of the market environment. Before you even think about placing a trade around a news event, check the spread. If you see it starting to widen, stay out. It's that simple. There is no edge in gambling on a news release when the mechanics of the market are stacked against you. There will always be another trade, another opportunity, after the volatility has settled and liquidity has returned to normal. A true professional knows which battles to fight and, more importantly, which ones to avoid entirely. Finally, turn this knowledge into power. The next time you find yourself in a long, boring consolidation, don't get frustrated. Smile. You know what's happening. You know big money is trying to shake you out. You understand the game being played. This awareness alone is a massive advantage. You are no longer an unsuspecting victim. You are an informed participant who can choose not to play their game. You can wait patiently and confidently, knowing that your discipline is your greatest weapon. The market doesn't reward frantic activity. It rewards precise, calculated patience. By understanding the scarcity illusion, you can finally align yourself with the smart money and let their manufactured moves work for you, not against you. So, let's talk about something I call the psychological pinch. It's that gut-wrenching feeling when you see a massive price spike and feel an overwhelming urge to jump in. Ever seen a currency pair or a stock absolutely explode overnight during the Asian session while you were asleep? You wake up, see a chart that looks like a rocket launch, and your first thought is, "I'm missing out, I have to get in now." This, my friends, is the volatility trap. Let's break down what's really happening. The Asian session, or other times outside the main London and New York hours, are periods of extremely thin liquidity. What does that mean? It means there are fewer buyers and sellers in the market. Think of it like a quiet country road versus a major highway. On the highway, a single car pulling over doesn't cause a traffic jam. But on that narrow country road, one stalled car can back things up for miles. In the market, this means a relatively small amount of capital can cause a huge, disproportionate price jump. A medium-sized order that would barely make a ripple during the London session can create a massive, terrifying spike when liquidity is thin. And this is where the psychology kicks in. These spikes are perfectly designed to trigger your FOMO, the fear of missing out. Retail traders like you and me see this massive green candle and we panic. Our brains scream, "This is it, the big move. If I don't buy now, I'll regret it forever." We throw our risk management out the window, ignore our strategy, and chase the price, buying at the very top of that spike. But here's a critical question. Where is the big money during these spikes? Are the hedge funds and major banks also panic buying alongside us? Absolutely not. For them to enter a massive position, they need deep liquidity. If they tried to buy billions of dollars worth during a low liquidity period, they would suffer from something called slippage. The price would move so drastically against them with each order that their entry price would be terrible. So, they wait. So who is causing these spikes? Often, these moves are engineered traps. They are bait. The purpose is to lure you, the retail trader, into buying at the absolute worst possible price. You're buying their shares at the peak, providing them the liquidity to take the other side of the trade. And what happens next is the brutal truth. As soon as enough retail traders have been suckered in, the price gets aggressively dragged right back down. When the main sessions, like London or New York, open up, real volume and liquidity return to the market, and the price snaps back to its true value zone, leaving you holding a bag at the top. It feels personal, it feels brutal, and it's a trap you fall for because you don't understand the dynamics of liquidity. Now, let's get even more specific and talk about what I call the dry blood hours. This is another liquidity trap that's directly linked to the time of day. To understand this, you need to be crystal clear on the main trading sessions. We have the Asian session, then London opens up, which overlaps with Asia for a bit. The most liquid time of the day is the overlap between the London and New York sessions, roughly from 8 a.m. to 12 p.m. Eastern Standard Time. This is when the two biggest financial centers are open and volume is at its absolute peak. After that, London closes and the New York session continues until 5 p.m. EST. But what happens after 5 p.m. EST? The market becomes a wasteland. It's a ghost town. Liquidity dries up almost completely. The big players have gone home. The party is over. The only ones left lurking in this desolate market landscape are the market makers and predatory algorithms. And they are not your friends. They are there to hunt. This is where another psychological flaw comes into play: impatience and desperation. Let's say you've had a losing day. The New York session is closing, and you feel that pressure to make it back. You think, maybe I can just find one more trade to break even. So you start trading in the dry blood hours. Or maybe you're the opposite kind of trader. You're scared of the volatility of the main sessions, so you deliberately choose to trade late at night, thinking it's safer. In both cases, you're walking straight into a hunter's snare. When liquidity is this thin, the market makers are in complete control. They can easily move the price to trigger your stop-loss orders. Spreads widen dramatically, meaning your transaction costs go through the roof. The price action becomes choppy, erratic, and unpredictable. You're essentially playing poker against a dealer who can see your cards and change the rules at will. That late-night trade you took to save the day suddenly gets stopped out for no apparent reason, only to see the price reverse and go in your intended direction moments later. That safe trade you placed to avoid volatility gets eaten alive by a widened spread. This isn't bad luck, it's a predictable outcome of trading in a zero liquidity environment. You are being ruthlessly hunted precisely because you're one of the few participants left, making you an easy, isolated target. The market isn't a 24/7 opportunity machine. It has prime hunting hours and dangerous, barren landscapes. Understanding when to trade is just as important as knowing what to trade. Respect the dry blood hours. After the main sessions close your charts. Go live your life. The market will still be there tomorrow, with fresh liquidity and real opportunities. Don't let impatience or fear trick you into becoming prey in the market's quietest, most dangerous hours. The professionals aren't trading then, and neither should you. I hope this has been a major wake-up call for you. Understanding these liquidity traps is a game changer. It shifts you from being the hunted to being the patient observer who waits for the right conditions. All right. Let's talk about something that completely changes the game in trading. It's not just about charts and indicators. It's a fundamental shift in how you see the market. Forget what you've been told. We're not here to hunt for opportunities. We're here to hunt for liquidity. This is the survival mindset, the predator's mindset. This is how you stop being the hunted and start becoming the hunter. So, what's this big paradigm shift? It's simple. Most retail traders are taught to look for patterns, breakouts, and signals. They're constantly searching for that perfect setup. But the market isn't a treasure map leading to gold. It's a complex ecosystem driven by one primary force: liquidity. Big institutions, the smart money, the whales, they aren't looking for a double bottom. They're looking for pools of orders to fill their massive positions. They need your stop-loss orders. They need your breakout entries. They need your panic selling. That's their fuel. So instead of providing them with that fuel, we're going to learn how to track them, understand their movements, and trade alongside them. We hunt where they hunt. And that place is where liquidity is rich. This isn't about finding a needle in a haystack. It's about waiting for the herd to gather at the watering hole. This brings us to our very first rule, and it's non-negotiable. Rule number 1, never trade the dry blood hours. What do I mean by dry blood? I mean those dead zones in the market where nothing is happening. Think about the late Asian session or the period after New York closes. The volume is low, the spreads are wide, and the price action is choppy and unpredictable. It's a wasteland. A true predator doesn't waste energy hunting in a desert. They wait for the most active, fertile hunting grounds. For us traders, that's when major market sessions overlap. The absolute prime time is the London-New York overlap. This is when the two biggest financial centers in the world are both fully operational. Liquidity is pouring into the market, volatility is high but structured, and moves are decisive. You need to internalize this. Patience is not just a virtue in trading, it's a weapon. Resisting the urge to trade during low liquidity hours is your first act of professional discipline. Accept that most of the time, the right trade is no trade at all. Mark the London-New York overlap on your charts, set your alarms, and treat that window as your designated hunting ground. Everything else is just noise. Now for Rule 2, and this is where we separate ourselves from the crowd. Wait for the predator to strike first. One of the most common traps in the market is the liquidity sweep, also known as a stop hunt or a Judas swing. This is where price aggressively pushes past a clear level of support or resistance, triggering a cascade of stop-loss orders and tricking breakout traders into entering the market. And what happens moments later? Price viciously reverses, leaving all those traders trapped on the wrong side. They become the liquidity. You, the hunter, will not be one of them. Your job is to observe this event, not participate in it. Let the big money, the predator, conduct its sweep. Let them clean out the weak hands. You wait. You watch for the sweep to end. You look for the moment price fails to continue in the direction of the sweep and starts reversing with conviction. That's your signal. Your entry is not with the herd rushing off the cliff. It's in the opposite direction, the direction smart money is now pushing the price after they've fueled up. You're not trying to catch the move. You're joining the move after it has already been established by the ones in control. This requires immense patience, but it puts the odds firmly in your favor. Let's talk about rule number 3, which is a game changer for risk management. Place your stops logically, not emotionally. Where does the average trader place their stop loss? Just below the last swing low or just above the last swing high? It's what every textbook teaches. And guess what? The big institutions know this. Those predictable spots are exactly where they go hunting for liquidity. They are magnets for price. So, we need to think differently. When you enter a trade after a liquidity sweep, ask yourself this question. If I'm right about this move, and smart money is now defending this new direction, where is the one place they will absolutely not let the price go back to? They won't let it go back to a point that would invalidate their entire maneuver. Your stop loss doesn't go in the obvious, easy-to-reach spot. It goes in the fortress, the logical point that, if broken, proves your entire trade idea was wrong from the start. For example, after a sweep of the lows and a reversal upwards, your stop shouldn't just be below your entry candle. It should be placed decisively below the absolute low of the entire sweep. Big money just spent a fortune pushing price up from that level. They're not going to let it come crashing back down without a fight. By placing your stop there, you're not just setting a risk limit. You're aligning your own defense with the institutional defense. This leads us perfectly into our final and most important rule. Rule number 4, liquidity is your friend. For so long, you've been taught to fear it. You've been told to stay away from volatile moves and stop hunts. But from now on, you're going to see it as the ultimate opportunity. High liquidity is what makes clean, efficient market moves possible. It's the lifeblood of the market. Your entire strategy should now revolve around it. You don't trade when the market is quiet. You don't trade when the direction is unclear. You only engage when liquidity is abundant, when the predator is active, and when volatility is being used to engineer a clear move. Instead of fearing a stop hunt, you now anticipate it. You welcome it, because you know it's the precursor to a high-probability entry. You're no longer the deer in the headlights, frozen by the fast-moving price. You are the hunter, using that burst of activity as a signal. It tells you where the action is. It tells you where smart money is operating. Embrace it. Your job is to wait for these liquidity events, identify the true intention behind them, and then, and only then, execute your plan with precision. So let's recap the hunter's code. First, the paradigm shift. You are no longer hunting for patterns, you are hunting for liquidity. Second, you only hunt during prime time, the London-New York overlap. Avoid the dry blood hours at all costs. Third, you let the predator strike first. You wait for the liquidity sweep to finish, then you join the real move. Fourth, your stop-loss is your fortress, placed at a logical point that invalidates the entire trade idea, not at an emotional or obvious level. And finally, you learn to love liquidity. It's not a threat. It's your greatest signal, your best friend. By adopting this mindset, you fundamentally change your relationship with the market. You move from being a participant to being an observer, from being the prey to being the predator. It takes discipline, it takes patience, but this is the path to survival and consistency in this brutal, beautiful environment. So let's bring it all together. What have we really learned today? Liquidity isn't just some dead metric on a chart, some squiggly line you ignore. It is the psychological tripwire that big money, the smart money, uses to control you. They manufacture scarcity. They create these moments of fake urgency to force your hand, to make you feel like you have to jump in or you'll miss out. It's a carefully crafted illusion designed to separate you from your capital. Are you tired of being played? Are you tired of feeling like you're constantly being forced to gamble by the market, especially during those quiet late-night hours? Then stop it. Just stop. You have the power to change this. Start learning to control your trading time. Be patient. Only participate when the conditions are right, when the liquidity is ripe for the picking, not when it's being used as bait against you. This isn't about finding a magic indicator. It's about mastering your own psychology and understanding the battlefield you're on. The market is a game of strategy, not a game of chance. You need to stop being a pawn and start thinking like the players who move the pieces. The first step is recognizing the traps laid for you. Now I want to hear from you. Comment below. Have you ever been a victim of the liquidity trap late at night? Share your story. Let's learn from each other's experiences. The more we talk about these traps, the less power they have over us. And if you found this breakdown valuable, if you want to keep seeing the brutal, unfiltered truths about the market that most people are too afraid to talk about, then do me a huge favor. Like this video and share it with another trader who needs to hear this. Most importantly, if you're serious about your trading journey, subscribe to Trading Mindset Lab. We're dedicated to helping you avoid the psychological traps that destroy most traders. By joining our community, you're taking a definitive step towards trading with clarity and confidence. We've got more content coming on smart money concepts and reading order flow, so you won't want to miss what's next. Thanks for watching, stay sharp, and I'll see you in the next one.